Okay, I have been missing for quite some time in the market. Right now, I am back on the market and the platform again. So today, recently, I just want to talk about a few things that are actually coming up on the platform as well as some questions online. Is the stock market overpriced and hyped right now or not? So we deep dive into this particular topic right now. So the first question that we always normally would see on the platform is the stock market overpriced right now? So with the recent studies, right, we can see that actually S&P is actually up about 11% this year. And we can see that the trailing PE is about 27, and yet the valuations of the company drop. Most of the Magnificent Seven, they actually drop. And if you can see the forward PE, right, it's actually even lower and actually cheaper. In fact, some are actually even cheaper than the prices that we can see during COVID. So what is this and why is this happening? So the first thing that we have to understand is that stock market, the prices on a long trend, it will always be going up. I am always bullish on this. It's just that in the short term, there will always be up and down. Why is that so? Because if you can see, right, stock market is actually driven by earnings. Earnings of the company that are great will always go up. In the mega trend, in the long trend, long term, prices normally go up because consumers drive consumption. Consumption drives earnings, see? So it's actually quite simple to listen like this, but it's very hard to predict and understand it in the short term because short term market is fluctuation and also affected by human emotions. Everyone is affected in a way. Some might think it's bullish, some might think it's bearish. So with this in mind, right, you have to think whether or not you buy and own this stock is for the long term or the short term. And with this, right, we can actually see and understand, is the market overpriced right now? I would say some part of the market, yes. If we can see from the studies, right, we can actually see that with the recent studies in the US, some of the companies are overhyped. Like for example, those that are involved in the AI, but yet not every company in the AI is making money. But because it is actually just saying that it is involved or actually investing in AI, many of them are actually hyped up already. But what I normally do is I look for companies that are actually producing cash flow. The cash flow can be huge and much higher than the capex that they are spending, or maybe 1 or 2 quarters their capex may exceed their cash flow. But in the long term, you have to understand why are they spending on capex. In order to expand any business in the world, we have to spend on capex. But capex, you have to limit to a certain limitation that it doesn't affect your overall business. But if you can understand that for any business expansion, you need capex. So how we actually identify whether or not that capex is healthy is we have to see what does the capex mean. Are they investing in infrastructure, in R&D, or are they paying out old debts or bad debts that they cannot recover and they cover it under the pretense of saying that this is actually capex. So this is how we actually identify great companies from average companies. So the next question that we normally see is, what are the valuations right now in the market? So for S&P trailing PE, right, if I can see from the chart right now here, the current PE is about 27 to 28. Historical average is about 20 or 19.7 like that. So we are above the historical average right now, but we have to understand what is the PEG ratio, the PEG ratio. The growth of the PE of the today's company is much larger and much faster than 10 years ago. With the AI and with the consumption of the people right now in the world, everything is driven much faster and much greater. The economy is growing at a much faster growth as compared to 10-20 years ago. So we cannot just take purely on the past PE and compare with right now what is the PE, because we have to take into consideration of the growth rate of these particular companies. Then only we can understand whether it is overvalued or undervalued. And question number 3 is, are there still gems out there? Yes, of course. But you have to understand, as a global investor, we don't just focus on US. There are many other markets, US, Hong Kong, China, Malaysia, Singapore, Thailand, even South Korea. There's so many markets right now that you cannot just simply say that the entire stock market is hyped and overpriced. Every company that has branches in all around the countries in the world, right, they actually contribute to one single result of the firm, you see. So maybe, for example, you might think this particular country is overhyped, overpriced. Then you look for other countries. Other countries have other stocks that are still undervalued. So this is how we normally balance out our portfolio. So the real thing right now, question number 4 that I normally get and see on the market is which stock market to focus on rather than the AI trend. Which particular sector? I would say right now, 50% of my portfolio is skewed towards defensive in nature, meaning to say consumer goods, staple goods that people will use no matter how good the economy, no matter how bad the economy, you will still use the products of the company. This is one of the defensive stocks that actually got beaten down by a lot since the starting of the year, I would say. Because everyone has limited capital, I would say, for majority, other than the big firms and also the hedge funds, right? All of us are basically, we have limited source of capital. We can only rotate around the market. If right now the market is hot in AI trend, that's where the hot money will go to. And that's where consumer goods, defensive in nature companies will drop because the capital flow out. But if you understand that there is always a trend in the market, is that for stock market, hot money will always go around. It will never be just in one area. Sometimes it will be in this trend, and 1 or 2 years later, it will be another trend. So it is to identify the trend and also identify in which particular sector or the trend cycle are we right now. So I would say that I am hedging my portfolio in a defensive nature by 50%, but I am not going all in on defensive as well because I am bullish on the AI trend long term. With this in mind, we can actually try to maneuver around because you can never beat the market on every year, but you can make sure that your entire ship doesn't sink because of one bad year. This is what normally we would try to grow our portfolio in a healthy way. Many people, I guess, some people, they are able to grow their portfolio by 100%, 200% in a year, but the second, the third year, they go back down 50%, go back down 100%, in fact, then it's go to zero again. What we normally do is we want to hedge, but also profit our portfolio and bring it year by year growth at a constant rate on average that we are able to have a very good, healthy forecast projection in the years to come, how much the portfolio would actually be worth and value at. So the final question that I would like to address today is the AI trend over? If I see from my studies here, Nvidia has 1 trillion in confirmed AI chip demand through 2027. Okay, so that is actual commitment, not projection. Blackwell chips sold out through mid-2026. Hyperscalers capex for the Max 7 projected around 755 billion in just this year alone. So the key structural difference versus the .com today is that actual companies are actually funding this with their actual cash flow. Some investors are arguing that look, their capex exceed their current quarter of cash flow. It becomes negative, but come on. It is actually funded by their cash flow. What is a negative quarter? What is a negative 2 quarters? If these negative 2 quarters can bring in expansion and fuel their business revenue and income for the next 2 years, 5 years, that is nothing for just 2 quarters of negative cash flow. And so long they are not getting this fund through credits, through bank loans or what, I would still view this as a positive AI trend. So be it in such a way that we see that this AI trend is not going anywhere. It is the way forward and it is our future as well. It's just we have to understand how long before we actually reach the critical mass of AI actually being implemented on the public mass market scale. So until that day, right, every year right now it is capex and revenue growth, capex, revenue growth, but until we see that trend being utilized by majority of the global world, that is where we actually know and confirm that the AI trend is here. It is being utilized 100% by everybody in the world. Right now, I would say they are spending their cash flow in a healthy way to making sure that this future is a confirmed future. Thank you.